In this presentation, we will take a look at and calculate profitability ratios. When thinking about different types of ratios, we do want to be able to categorize those ratios so that we get a better understanding of what the objective of the ratios are, and so that if we're tested on these types of categories, we know what they are as well. These are common types of test questions to group the different types of ratios. We've taken a look in prior presentations at liquidity and efficiency ratios, solvency ratios. We're now looking at profitability ratios. When thinking about profitability, we're thinking about the company's ability to generate an adequate return on invested capital. In other words, we're thinking about a performance type of calculation. How are we doing given the resources, the capital that we have? The other category we'll take a look at in a future presentation is market prospects. Profitability ratios will include, we're going to have the profit margin, we're going to have the return on total assets, and we'll have the return on common stockholders' equity, the return on equity. Starting with the profit margin should be a common ratio that we have some familiarity with. It's going to be the net income divided by the net sales. So remember, whenever we see net income, we're talking about the bottom line in this case. Net sales, on the other hand, represents basically sales or revenue, the top line, not the net income. So net sales is going to be the top line. It's going to be net because it'll be net of any kind of contra sales account. So if we have a detailed income statement, we may then have the breaking out of the contra sales accounts of allowance and discount. It's net of those contra sales accounts, which aren't expense accounts, and therefore that gives us the total sales. And then we have the net income bottom line on the income statement. If we take a look at our data, we have the income statement for A and B here. We can consider them as two separate companies, two sets of data. We have our income statement. We're going to start off with the net income. Net income is going to be the bottom line, so the 164,508 and the 202,903. We're going to divide that by the sales. So this is going to be the top line. This is what we're generating, the revenue, minus all the expenses gets us down to the bottom line. We divide those two out and we get our profit margin. So if we were to calculate that with a calculator for A at least, it would be the 164,508 divided by the 780,000. And that's going to give us the 21.1 about. Note, we're always going to be having to deal with rounding. When we consider this ratio, we're looking at the bottom lines. That's the net income, what we're walking away with in essence, in terms of net income as compared to the revenue that we're generating. So if we think of every dollar of revenue, the net income is basically what we have left at the end. If we take a look at that ratio, the income, what we have left at the end related to the net sales, we can think of it as for every dollar, how much we're walking away with, 21 cents, 0.21 of each dollar of revenue. So obviously we want this to be higher. We want the net income, what we're keeping, what we're holding on to after expenses, to be higher in relation to the earnings, to the revenue that we have. So in this case, B is looking better than A with regards to the profit margin ratio. Next, we'll take a look at the return on total assets. Calculation is going to be the net income divided by the average total assets. So we're comparing here the net income. Now we're talking about the bottom line, not the net sales. So we're not talking about revenue. We're talking about the bottom line, what we're walking away with at the end of a time period. This is a timing account. This measures a time frame or period, a period of time, a beginning and an ending. And we're comparing that to the average total assets, which of course is a balance sheet account or balance sheet grouping of accounts. The total assets as of the end of the time period is when the assets are reported on the balance sheet, and we need the average then. So the average makes sense because we're trying to compare the average to an income statement account, which represents a total time period. Therefore, we want to pick up the average, which would be an average amount as of any given time period within that time period. So we're going to do that by taking the beginning balance plus the ending balance and dividing by. If we think about this ratio, remember that the net income is the net of what is happening, revenue minus expenses, and we're comparing that to the total assets. The total assets are what the company has, and the reason we have the assets is in order to help us to generate revenue, in order, in essence, to help us to generate the net income. So we're comparing basically a performance account, net of the expenses, as compared to the average. How well are we, in essence, using our assets in order to generate revenue? What's the return on those assets? Let's take a look at an example. Here's our data. We have the balance sheet. We got the income statement. We got the prior year data. We're going to have to break this out. This is a longer type of calculation once again because we have the average down below. And remember, when we have the average, we're going to have to break out beginning and ending year. I would recommend visualizing a table, whether you do it in Excel or on paper, actually writing down each step rather than just punching it into a calculator for these mid steps, so that you can see each step along the process. If you actually physically write it out or put it in Excel, look at a table, you'll be able to visualize it better and be able to write it down easier when you have to with limited time. You'll also learn it better as well. So we're going to start off with the net income. That's going to be the 164,508. That's going to be the income statement account, the timing account, not the top line of the income statement, not the revenue, not the sales, but net income. Then we're going to have a subcategory to break out and calculate the average total assets. Average total assets is going to be calculated on the inner column here. So we're going to bring that inside so that we can do this sub calculation that we'll then bring out to the outer column. It's going to start with beginning assets. That's not going to be on our financial statements. That's the ending assets. Where are we going to find the beginning assets? On the prior year financial statements, because the prior year financial statements represent the ending assets as of the prior year, or the beginning assets for this year. So we'll take a look down here at the prior year information, picking up the total asset number. Then we're going to take the ending assets, which is represented on our financial statements because the balance sheet is as of a point in time, as of the end of the time period. Therefore, the ending assets will be picked up here. We're going to add those two up. Why? Because we want to take the average of them. We're going to add them up, divide by the number of items that we have, which is 2. So we'll divide that by 2. That gives us the 450, 370 for A, and the 471, 275 for B. Then we can finally do our calculation here as it's shown in our ratio, that being the 164,508 net income divided by the 453,770, or in the 0.36, or the 36.5%. Remember that we're always going to have to basically be dealing with rounding. Many of these are not going to be even, and therefore rounding is going to be something we always have to consider and deal with. When looking at this, remember this is the net income. We want this to be as high as possible, and this is going to be the average total assets, what we're using, the resources we have in order to help generate the goal, which is basically going to be the return, the net income. So in essence, of course, we want this number to be higher. So the higher the number, the better we're looking here, because we want the net income to be high as relation to the average total assets, and therefore B is looking better than A for the return on assets. Next, we have the return on common stockholders' equity, and that will be calculated as the net income minus the preferred dividends, if we have any preferred dividends, and we're going to divide that by the average common stockholders' equity. This measures the company's ability to earn income for common stockholders. If we think about this calculation, the top line, of course, is going to be the net income statement number, or income statement number of net income. It's the bottom line of the income statement. This is a performance number because we're on the income statement. We're talking about how did we do over time in terms of net income, not the top line, but the bottom line, the income minus the expenses. We're going to subtract out the preferred dividends if there are any, because we're considering the return as it's related to the common stockholders, the normal type of stockholders, who we typically think of as the owners, and the preferred dividends then would need to be removed for that type of calculation. It's possible that the company doesn't have any preferred dividends, and in that case, of course, then we wouldn't have to deal with the preferred dividends calculation. So remember, the common stockholders is what we typically are thinking of, because they're typically considered as the normal type of owners of the company. We're then dividing that by the average common stockholders' equity. So in essence, we're dividing by equity, and we can consider what the equity is going to be the book value of the company, the assets minus the liabilities, or the amount of the assets that we're attributing to or have claim to by the owners, as opposed to a third-party liability. So we're comparing the performance of the net income, how did we do in a timing statement, to the equity section, the book value of the company, or the amount that's basically owned by the owners. In other words, you can think of it, the assets of the company that the owners have claim for, we are comparing to the performance of the company in terms of the net income over a certain time period. Because the equity section is going to be a balance sheet account, and the income statement is for a time frame, has a beginning and an end, as opposed to the end of the period on the financial statement, we are then taking the average, which will give us an average amount over a given time period, that same time period, the year. So in order to do that, we're going to have to take the beginning balance plus the ending balance, divided by 2. Let's take a look at an example. Here's our data. We're going to have our balance sheet up top. We got our income statement down below and some prior year data that will be necessary. This will be a bit longer of a calculation, of course. One, because we might have that preferred dividend, but two, because we have that average common stockholders equity. Once again, once we do that, we want to visualize the table because we can see there's going to be a lot more calculations than we're going to do than we can see in just the ratio that is typically given. And therefore, we want to be able to write that out, consider it. The more we have down on paper, the more we can visualize it, the less likely we are to make a mistake or get confused, miss a step. Therefore, I would practice writing it down in a longer format. We're going to start off with the net income. I'm going to put that on the right side. The net income, of course, is on the income statement. It's the bottom line of the income statement. We'll subtract out preferred dividends if there are any. There are none in this example problem. Therefore, we'll subtract out 0 and end up with the subtotal, which is the same as the net income, or the net income minus the preferred dividends. Then we're going to pull into the inner column the average equity, calculating the average equity in that inner column. To do that, we're going to have the beginning equity. Where's the beginning equity going to come from? It's not on the balance sheet because that represents the equity at the end of the time period. We want the beginning of the time period. Where's that going to come from? The prior year financial statement. Prior year financial statement represents the end of the prior year and therefore the beginning of the current year. So we're going to take a look at the equity section for the prior year. That's going to be, in our case, the common stock, the 170,000 plus the 161,592 for A. That'll give us our 331,592. Then we're going to pick up the ending equity. That's going to be on our current financial statements. Here's our ending equity, which is going to be the 170,000 plus the 198,600. That's the, for A, the 368,600. Then we're going to add those two together. We add those two together, we get the 700,192. Why do we do that? Because we want to take the average. How do we take the average? We got two numbers. We add them together and we divide by how many numbers we have, which in this case is 2. That'll give us the average, which we're going to pull out to the outer column here. We're going to pull the average back out to the outer column. And now we can do the calculation showing we have our two numbers that are in our calculation, the one being the net income minus the preferred stock divided by the average common stockholders equity. Let's push that into the calculator now. We got the 164,508 divided by the 350,096. That's going to give us our 47% about. So remember, we're always going to be having to deal with the rounding. So note up top, we in essence have the net income. So we're starting with the net income up top. We're comparing that to our equity. Now note the equity represents the claim of basically the owners of the assets. So the claim of the owners of the assets, the fact that it's in the company and not being distributed to the owners is basically representing how much of their investment is still in the company. What we want to do is have as high a return as possible as compared to that equity in the company that the owners are basically having claim to and are keeping in the company. Why is it there? In order to help us to generate revenue, in order to help us to generate a return or net income. So in essence, we want this number to be high as compared to this number. So if we take the net income divided by the equity, we would want this to be higher. And so in this case, B is looking better than A, it having a higher return on common stockholders' equity.